Welcome back to my YouTube channel, Price Action Framework. Have you ever wondered where a pullback may be coming to an end before the downtrend continues? What if price pulls back toward the 61.8% Fibonacci retracement and a shooting star forms at that exact location? In today's lesson, I'll show you how to combine measured move projection with Fibonacci retracement to identify high-quality locations where a shooting star becomes much more meaningful. Let's get started. Before we move on, let's quickly recap what we've learned so far. Throughout this series, we've learned that a shooting star is only the beginning. When I see a shooting star, the first thing I evaluate is its location. Let's look at this chart. We already know this area has upper channel resistance. Now let's identify the swing high and the swing low. From there, let's draw the Fibonacci retracement. Notice where the shooting star formed, right around the 61.8% Fibonacci retracement and right at the upper channel resistance. That's not a coincidence. The market is telling us that multiple pieces of evidence are pointing to the same area. That's what we call confluence. Instead of relying on just one signal, we combine multiple location tools to identify a higher quality trading location. A shooting star tells me what happened. Location tells me whether it matters. But here's something even more interesting. The 61.8% Fibonacci retracement and the upper channel resistance aren't the only location tools on this chart. There's one more, measured move projection. Let's see how it works. Have you ever noticed this? After a strong bearish impulse, the market begins to pull back. At this point, many traders assume the downtrend is over. But is it really? One useful technique is the measured move. Here's how it works. The market first makes a strong bearish impulse. Then price pulls back. Many traders assume the downtrend is over. But sometimes it's only a temporary pause. As price approaches an important location, a shooting star may begin to form. If sellers regain control after the shooting star appears, price begins a second bearish impulse. In many cases, the second bearish impulse travels roughly the same distance as the first bearish impulse. That's what we call a measured move. Keep in mind, the second bearish impulse doesn't have to be exactly the same length as the first. Sometimes it falls short, and sometimes it extends beyond the projected target. So use a measured move as a guide, rather than expecting an exact price target. Now let's put this concept into practice. Can a measured move help us evaluate whether a shooting star is forming at a meaningful location? Let's find out. Let's put ourselves in a real trading situation. Imagine you're analyzing this daily chart, and a shooting star has just formed. Would you enter the trade immediately? I wouldn't. At this point, we still don't know whether sellers are truly regaining control, or whether buyers will continue pushing the market higher. Before making any trading decision, I always ask one simple question. Is this shooting star forming at a meaningful location? Remember, a shooting star is only the beginning. Its location determines whether the signal is worth paying attention to. So let's examine the chart together. We can clearly identify the first bearish impulse, followed by a corrective pullback. Now notice where the shooting star appears. It forms near the end of that corrective pullback. Is that enough to justify taking the trade? Not yet. One good location alone isn't enough. I want to know whether another independent technical factor supports this same area. This is where the measured move projection becomes useful. Let's see how it can help us evaluate whether this shooting star is forming at a truly meaningful location. We've already identified the first bearish impulse and the corrective pullback. Now it's time to build our measured move projection. The process is actually quite simple. Step 1. Measure the distance of the first bearish impulse, also known as leg A. This is the initial downward move where sellers clearly take control and push the market lower. We'll start at the swing high. This is where the bearish impulse begins. From here, and we measure all the way down to the swing low, where the first bearish impulse comes to an end. This gives us the complete length of leg A, and we'll use that same distance in the next step. Now let's focus on the corrective pullback. I'll zoom in so we can see this area more clearly. Notice the highest point of the corrective pullback, because this is where we'll begin our projection. Next, we copy the same distance we measured in leg A and project it downward from the high of the corrective pullback, also known as the leg B high. This gives us a projected target for the second bearish impulse based on the length of leg A. Keep in mind, this is a projection, not a guarantee. Price may fall short of the projected target or extend beyond it. That's why we use it as a guide, rather than expecting the market to stop at an exact price. Our goal isn't to predict exactly where price will go. Our goal is to identify another meaningful location to evaluate. If this shooting star is truly marking the end of the corrective pullback, then it may also be signaling the beginning of the second bearish impulse. Now let's bring everything together. Let's start with what we already know. This key location is also where we find the upper channel resistance. Personally, I pay a lot of attention to parallel channels. They're one of my favorite tools for identifying high-quality trading locations. Whenever I spot a shooting star on the daily chart, one of the first things I check is whether it's forming near the upper boundary of a parallel channel. If it is, I immediately pay closer attention, because sellers often become active around these resistance areas. Next, let's add the 61.8% Fibonacci retracement. Notice that the pullback also reaches this level. Fibonacci is another tool I rely on heavily when evaluating pullbacks. I pay particular attention to the 50% and 61.8% retracement levels, since I prefer selling into pullbacks rather than chasing the market lower. These are usually the first areas I examine for potential bearish reversal signals. And with enough chart experience, you'll often begin recognizing these key retracement areas visually before confirming them with the Fibonacci tool. So now, we already have the upper channel resistance, the 61.8% Fibonacci retracement, and now our measured move projection also points to this same area. Take a moment and look at the chart. Everything is starting to line up. Finally, a shooting star forms right here on the daily chart. This is exactly the kind of setup that catches my attention, because now I'm no longer relying on just one technical tool. I'm seeing several independent pieces of technical evidence, all supporting the same idea. This is what traders call confluence. The more independent evidence supporting the same area, the more meaningful that location becomes. Does this guarantee the market will move lower? Absolutely not. Nothing in trading is guaranteed, but it does tell me one very important thing. This shooting star isn't forming by chance. It's forming at a high-quality location, where sellers may be preparing to step back into the market. The shooting star gives me the timing signal, while the measured move projection provides the target framework. Together, they create a much higher quality trading setup. But even with all this confluence, I still don't enter the trade immediately. I want confirmation that sellers are actually taking control. So let's reveal what happened next. All right, let's reveal the future candles and see what happens next. Now let's see how the market responds. Instead of pushing higher, price starts moving lower. That's exactly what I wanted to see. Notice how sellers begin stepping back into the market, and the second bearish impulse begins. This is where everything starts coming together. The measured move projection gave us a projected objective, while the shooting star, confirmed by the market's reaction, told us that sellers were beginning to regain control. Together, they helped us understand where the market was likely to react, and when sellers were actually taking control. That's exactly why I never rush into a trade. I let the market make the next move before I make mine. Before we finish, I'd like to leave you with one final thought. In today's lesson, our pullback was relatively simple. But if you've been trading for a while, you already know the market isn't always this clean. Sometimes the pullback develops into a bull flag, a rising wedge, a rectangle, or even an ascending triangle. But don't let that confuse you. The pattern may change, but the principle stays the same. No matter what the pullback looks like, the way we analyze it stays exactly the same. As you gain more chart experience, you'll begin recognizing these pullback structures much more naturally. We'll dive into each of these pullback structures in future lessons, so there's still a lot more to come. If you don't want to miss those lessons, make sure to subscribe to my YouTube channel, Price Action Framework. Thanks for watching, and I'll see you in the next lesson.